We are live. It is Tuesday. It is 6 p.m. Let me double check that recording is on. It is. So this is Office Hours Q&A. We do these every Tuesday at 6 p.m., at least Eastern Time. That's where I live. So that's what I make the times in. And I'm Neal. We've got Serena here. And I'm the founder and chief tax strategist here at TaxSherpa. And the quickie version of what it is that we do is we help mostly independent contractors, solopreneurs, small business owners save tens of thousands of dollars on their income taxes every year. The older that I get, the less the dollars matter to me, which sounds weird. But the reality is that it's not so much the dollars that I end up finding important as it is the time. Because what happens is most people, they go to work and then they do their thing, whatever that thing is, and then they come home and then they spend time with their family or whatever it is that they're doing in their personal lives. And then at the end of the year, they file tax returns. And for small business people, whether you're an independent contractor or actually own a small business with other people, whatever it is, you're going to end up owing money most of the time. And whether you pay in quarterly or you just pay once at the end of the year, whatever, doesn't matter. The total remains the same. And then if let's just pick some numbers. Let's say you make $200,000, and because of your tax filing situation, you end up paying $80,000 to in taxes, right? So did you actually make $200,000? And the answer is no, because 80 of it went to the government. How much time during the year did you spend making that 80? And if we can shrink that from 80 to whatever, I'm just picking numbers here, from 80 to 30, right? That 50 difference is time you get back for yourself. And the older I get, the more important that becomes. Whether you're single or married or have kids or don't or whatever, your life is your own, my life is my own, and we want to spend our time working on behalf of whatever it is we want to work on behalf of, rather than turning that time over to the government. Because that's what happens when you're paying taxes. You went to work in order to support the government, and that's not a good use of your time or mine, as far as I'm concerned. That's the perspective that I come from, and here we're doing Q&A. So let's dive into it. I'll give you the quick background on me. So back in my educational days in 2000, I was working in as an engineering intern out in Texas. And that's when I realized, yeah, this whole thing is not going to be for me. The whole corporate world. I majored in engineering at school, and yeah, this is a whole waste of time. I started doing my own thing. I went into business for myself. I was doing the solopreneur thing, and I did a multitude of things. And then after several years of that and not doing things correctly, I started getting nasty letters from the IRS saying that I owed them $1.3 million. And so, like most people, I ignored it and stuck my head in the sand. And my recommendation is don't do that. So it was a series of years and a series of escalations that happened. So if you haven't been through the process, trust me, it's not fun. But I ended up fixing my own problem. And in fixing my own problem, I fell into this whole world of Wall Street tax planning. And all those people saying, oh, the fat cats and the hedge fund guys, they all have all these loopholes. It's like, yeah, they do. And so what I've done over the last 15 years or so is to take all those loopholes from Wall Street and bring them down to the you and me street or Main Street or whatever you want to call it, to that small business level, rather than leaving it exclusively for the people who can pay hundreds of thousands of dollars in tax advice. So that's my mission. That's the mission of TaxSherpa, is to help my tribe of solopreneurs, small business owners, get their quality of life back by saving on their taxes. I love this quote. I say it every week. The quality of our questions determines the quality of our life. And it's attributed to Tony Robbins. I don't know if he said it first or not, but that's where I read it. My question is, what is the root problem with overpaying on taxes? And I already answered this, but the root problem is you're wasting your life because you're not working for your own goals. And like I said, whether that goal is to spend more time on my business or to take more time off and just go on vacation, or I want to support my family more, or whatever, going to Vegas and blowing all the money, that's still a better use of your time and your money than sending it to the government, at least in my view. So that's the core problem, is that you're wasting 74 days a year in the pursuit of working for not you. And I want you to get all that time back. I have the answer to all tax questions. It's a magic
Drum
answer.
roll.
The answer to all tax questions that I've ever been asked or that I've ever heard. The answer to all questions is it
It
depends.
depends. Yeah.
And people say, what does it depend on? And it depends on what we call facts and circumstances. So Everything depends on your particular situation. This is part of the difficulty with giving broad-based tax advice because you got to look at somebody's individual situation. There was I'm trying to think of a good example. The, the one I always go to is a little bit not PG, but I'll go into it anyway. So there was an exotic dancer, and she had cosmetic surgery done, and she wrote off that expense as a business expense, and the IRS disagreed with that, and because cosmetic surgery is elective, so it's not a medically required thing, and therefore it's not a deduction. So they ended up going to tax court, and she was able to demonstrate that because of this cosmetic surgery, that her income went up, and for whatever reason, you can draw whatever conclusions you want from that. And so, therefore, because it was in the pursuit of more income, that makes it a business expense and not a personal expense and not a medical expense. So it's a different category, even though the the operation itself is the same as cosmetic surgery that plenty of other women do for personal reasons. Same surgery, same operation, same everything, same costs, but one person in one situation can't do anything with it tax wise. Another person in that same situation can use it for tax deductions. And the reason is because the facts and circumstances are different. Whenever we go through these questions, sometimes it takes me a long time to flesh it out because I go through all these different scenarios. We'll see what happens. So part of the fun for me of this whole Q&A thing is that I don't know what's coming.
Right.
Serena just gives me the questions, and we'll see what happens. Let's see here. So yeah, so what do we have up first here, Serena?
So we have an R&D tax credit question.
Ah,
Yep. So a client wants to know, how can I leverage the R&D tax credit for my small business or startup company?
so I had that reaction because the R&D tax credit has been screwed up lately.
That's true.
All right, so this is section 174. So here's the general idea: is that if you have, it's called people call it the R&D credit, but it's actually the credit for increasing research activities. So
Okay.
there's a couple different categories of thing that apply, but basically, if you're creating new products, new processes, new software, all that kind of stuff, those are all qualify for increasing research activities. And if you're a scientific company that is doing like what most people will call scientific research, that's going to obviously qualify. But a lot of companies are not doing what we would call science, but do qualify for research, just because the way it's defined is just new processes, products, and all that kind of thing. So depending on what the business is doing, then it very well might qualify. The problem with it is that the specific category of developing software products is has been the language around it has been changed. In fact, what I'm going to do actually is I'm going to bring up the code. You go over here. Let's go to now law, and I want, let's see, amortization of research expenditures. Okay, so let's go back over here. All right. So this is the way the law is written, and there are special rules for some categories. The one we see the most of is software development. So for the purpose of this section, any amount paid or incurred in connection with the development of any software shall be treated as research or experimental expenditure. And the treatment that it has to go through is a 5-year amortization. And this language kicked in 2 years ago, I think. So what ends up happening is that let's say you have $100,000 of expenses that qualify. So that 100,000 gets split up over 5 years. And then, so you get 10,000 in the first year. It just assumes everything goes to mid-year. It's called a mid-year convention. And so you get 10,000 the first year, 20, 20, 20, 20. So that's 80 over the next 4 years, and then 10,000 off the last year. So it starts in the middle of this year, and then it ends in the middle of that last year. And so the difficulty there is that you don't get to deduct the 100,000. You only in year one, you're only deducting 10. Now you do get a credit for the 100, which usually works out around 6%. So there's some variations depending on time in business and all this kind of stuff, but usually around 6%. So you get, if we have $100,000, then we have a $6,000 credit, and we have a $10,000 deduction from the amortization. And so that's okay, but it's not as powerful as it was before this rule change of, I think it was 2 years ago. And there has been legislation introduced in Congress to fix this, to turn it back to the way it was, because Plenty of Silicon Valley types have complained to Congress about it and how it's really harming them because they still have the cash flow expense. They still have to pay the 100 to whoever their server costs or developers or whatever, but they're not getting the tax benefit from that spending, at least to the same degree as they used to. So it's put a crunch on a lot of companies that are, very influential and have a lot of money. There has been legislation introduced to fix this issue, but to date it has not passed. They said they were going to. It passed the House and it's stuck in the Senate. We'll see. The R&D tax credit was a lot more powerful up until recently, and it might become more powerful again soon, depending on what Congress decides to do. But that's the current state. Fundamentally, the answer to the question, though, is you identify your research expenses, and then different categories of expenses have different percentages applied to them. So contractors versus employees and stuff like that. And then you go through a formula. There's a simplified credit and there's a not simplified credit. And usually you want the not simplified one. It's more powerful. And then you end up with an amortized deduction and you end up with a credit. So that's the process by which you go through. But in terms of net impact, not as powerful as it used to be. And we're still hoping Congress will fix the problem that they made. Because this is part of a larger context in that the Tax Cut and Jobs Act was passed at the end of 2017, and it was a 10-year tax plan. And the reason for that is because when they pass legislation, the Congressional Budget Office does a 10-year impact study. Say, okay, if this law passes, then over the next 10 years, it's going to have this effect on the budget. And in order to get that report to come out attractive, they had to do a bunch of weird things. People who lost the ability to, everybody lost, but it only mattered to some people who lost the ability to deduct their state and local taxes. So if you're a high income earner in New Jersey, New York, California, one of these high tax states, your state and local tax deduction is limited to $10,000. So if you're a Facebook employee and you make 400 grand and you're living in California and you pay like 80 grand in California taxes, you get 10, right? And that extra 70 that's just, you're out of luck. So that was one of those things that was to quote unquote pay for the other tax cuts that were passed. Some of the other things that were done was that provisions that started off strong in the tax code were attenuated towards the end, and we're in that ending phase now. So bonus depreciation is decreasing. We had the R&D tax credit change that kicked in 2 years ago. So there's a bunch of like weird gotchas with that. Now, I don't know if you guys noticed, but it's looking like Trump is going to get reelected. And so if that happens, then it's a political question. It's okay, if Trump gets back into office and there's enough Republicans in the House and the Senate to pass some legislation, then it's highly likely that whatever tax issues that are expiring or are not as advantageous as they were are going to get renewed or reintroduced or updated for the next however many years. That is a very real possibility that we're looking at. And you can't rely on anything because you can't rely on anything until it happens. So this tax bill that was introduced in January to fix these R&D problems, for example, passed the House. Senate said they were going to pass it, and then they got distracted by Ukraine war stuff and whatever. So you can't rely on the politicians, basically. But there's a strong chance that things will get improved as we go into the expiration of the Tax Cut and Jobs Act, which is the date of the reform back in 2017. So yeah, and that's just another level. It depends.
That's true.
In that it will depend on the political context that will apply in the following years for the R&D credit specifically, as well as a few other things.
Understood.
All right. So that's my it depends answer.
Understood. All right, Neil. So we have another question about someone selling their company. They want to know what should I be aware of tax-wise as I'm thinking about selling or transferring ownership of my business.
Okay. So the exit planning should be done years in advance, ideally at least 5. And ideally when you start. So there's a couple big things when it comes to exit planning. And I'm not going to have the time to go into every single one, but there's a couple big moving blocks. So one is it depends on the size of your business. If you are under $5 million of sale price, generally you're going to be selling to another individual investor or maybe a small group of investors. If you're over 5 million, then you start to attract the attention of the private equity shops and the hedge funds and all that kind of stuff, the smaller guys in that world. Obviously, most businesses sell for less than $5 million. So There are a couple tax incentives that exist for selling your company. So the most basic one is that the most sales are asset sales, meaning that your company has some intangibles like goodwill or customer lists or contracts or whatever, separate from like physical equipment. So we live in a surface-based economy these days. Most assets that are sold, most businesses are sold as asset sales. Most asset sales consist of intangibles. And so what you end up with is a very low cost basis on those assets. And you end up with long-term capital gains. So that's thing number one. And long-term capital gains is going to be relatively advantaged compared to ordinary income. So depending on how much you are actually making overall for the year, you're looking at either 0%, 15%, 20%, or 24% when it comes to federal taxes for long-term capital gains. So at the highest levels, it's 24% as opposed to 37% on the highest federal ordinary bracket. Incidentally, the Biden administration, when they released their 2025 proposal, they want to get rid of that. So that's something worth noting. So you're already cutting your taxes not quite in half, but close to half, 40% or so, just by doing that. And that's like the least efficient thing to do. So from there are other options. There are people who have set up deferred sales trusts, which is an interesting strategy where basically the money goes into a special vehicle and then you get paid out over time and it spreads that impact out over time so that you can play the rate game so that instead of paying 24%, you're paying 15%, and then you can break it up over a couple of years. There's stuff like that. But the bigger things are if you have stock sales. So in order for the stock sales to work, you have to have a C corporation, which is not a pass-through. So most small businesses operate as pass-throughs. The vast majority do, because in most scenarios, it'll lower your current year taxes significantly. And money now versus money later, money now is more important, just time value of money kind of calculations. So if you forego that though, then you have two big incentive options. So option one is the ESOP strategy, where if you sell at least 30% of the stock to your employee stock plan, then and you got to get independent valuations and all this kind of stuff. There's a bunch of rules to follow. But if you do that, then that is tax free for you. And the thinking there is that you're sharing the wealth with the people who built the business. So that's a great potential incentives. The other incentive is 1202 treatment, which is founder stock, where if you own a C corporation for at least 5 years, and there's certain date ranges that apply, but basically all companies at this point qualify, you can sell the stock for up to a tax-free amount of 10 million bucks. So that is a huge incentive. And again, the idea there is that we being the Congress, we want to reward people for building businesses that provide economic value and then getting that value working in the wider economy. And yeah, so potentially 10 billion bucks tax free is amazing. And in most states, that carries through on the state level as well. So it's a fantastic incentive. But the problem is that, like I said before, most sales are not stock sales, they are asset sales. And the reason for that is because the buyer, if they buy your stock, they're also buying all the history of whatever happened before, which they have no control over. If you Just like if you're in like on the stock market, if you buy a stock and that company gets sued for something that happened 5 years ago, that's still going to affect your stock price today. So the same issues happen potentially with selling your own stock of your own company. And so because of that risk factor, the vast majority of sales at that level are done as asset sales because that severs the history and the liability from the old entity to the buyer. But that is a potential negotiating point to work in. It says if I sell you as stock, then my tax impact is way better. I know you want the asset thing, but maybe we can meet somewhere in the middle, and then that's just a negotiation to have between the buyer and the seller at that point. So we've got a few clients that are attempting that particular strategy, but it's a multi-year process. So we'll see how it goes. But that is my
Understood.
and that's not everything when it comes to exit planning, but those are some of the big moving pieces.
So when it comes to real estate, investing in real estate, what are some tax benefits there? Like that you can say,
Oh
work.
well, a lot.
Give me
So
two. Oh,
so the fundamental advantage of real estate when it comes to taxes is depreciation. Whether you're buying a residential property or commercial property or a multifamily or whatever, you buy a, or I should say, leverage and depreciation. So you buy a property and you'll have a certain amount of income associated with it that you're renting out or doing whatever you're doing with the property. You'll have cash expenses with that. You'll have your insurance, you'll have your mortgage, you'll have your property taxes, utilities, all the things that go along with owning the property. And also, when it comes to the mortgage, some people, especially smaller investors, don't really understand this, is that the mortgage payment that you're making is not all deductible. Only the interest is deductible. But what happens is that the building that you bought, the real estate that you bought, gets depreciated over time. And how much time depends on what kind of property it is. But generally, you're going to be writing off 3 to 4% of the building cost each year. So your cash basis profit and loss might show a profit of, I'm just picking a number, $5,000, but you have a depreciation loss of $8,000, and that means you have a tax loss of 3,000. Okay, again, just picking numbers. So that depreciation is amazing because you didn't actually pay out of pocket the full amount. If you had to pay cash for the property, then it wouldn't be that attractive because the depreciation that you get would not overcome the fact that you had to lay out $300,000 or whatever the number is. But because the banks will lend you money, at least, and the vast majority of the money to buy the property, then you get to get the depreciation on the full amount while only laying out the cash for a small amount. And so because of that dynamic, almost all rental real estate of whatever kind runs at a loss on a tax basis. So that's the first level of tax incentive for real estate. So whether you're able to use that deduction, that loss or not, depends on other factors. Depends on what else is going on in your tax world. But if you are able to use that, then there's a second layer of depreciation strategy, and that's called cost segregation. So when you buy, let's just pick a house. You buy a house. The house is not one thing. The house is a lot. There's a piece of land associated with it. There's probably a driveway. There's sidewalks. There's landscaping. There is a building there. There's that. Inside the building, there's cabinetry. There's wiring. There's ceiling fans. There's tile. There's flooring. There's all these different things are all packaged into this thing we call a house. And so what cost segregation does is it goes into all of those different pieces and it segregates, it separates those all those assets into their own categories because they all have different levels of or different rates of depreciation. So like a residential house, 27 and a half years. A ceiling fan, 5 years. And with bonus, mostly in year one. By segregating out the different pieces into different streams of property classes, then we're able to accelerate the write-offs from being spread out over 27 and a half years into years 1, 2, 3, 4, 5, primarily, and mostly in year one. So if your tax situation allows for it, then you can get huge depreciation in that first year. And if you do it really right, then you can actually get enough depreciation in the current year in order to generate yourself a tax refund so that you can then take that money, put it down on another property for the following year. And then you're just able to roll that same strategy because every property can be cost segregated. So you can just acquire an endless stream of properties for the one-time cost of buying the first property, which is an amazing strategy. And there's a lot of hoops to jump through to make that work. But if you can, it's super powerful. So that would be like layer two of real estate. But yeah, so you asked for two, that's two. I don't want to go on. I don't want to go off for another hour on just real estate because I know we got other stuff.
Understood, no worries. Next question, Neil, is about the structured ownership program, the SOP. How does that work?
So that is an advanced strategy for
Okay,
people who have a lot of tax liability, essentially. It's too much to go into here, but
it is.
but basically this falls under what I call the exotics. So there's three classes of tax planning. So class number one is individual level issues, retirement planning and charities and stuff like that. Level two is within your business. There's tax planning opportunities, and that's sculpting cash flows and entity structuring and all that kind of stuff. And level three is the exotics. And this is where you start to not incorporate, but you start to have to deal with other parties. It could be buying tax credits. Like the big thing right now is solar tax credits. And actually, the IRS, Serena, you showed me an article or press release from the IRS saying that
Mhm.
there's a bunch of scams going around with solar
Mhm.
credits. And so that's the current craze in the industry. But there's a bunch of them. So the structured ownership program is a strategy that involves going into partnership with other entities that are using very specific rules about how certain types of assets are treated for tax purposes in order to generate large net operating losses for you. So basically, you put in X dollars, you get out a large tax deduction this year. And that's the super short version.
Okay.
Obviously, it's way more complicated than that and beyond the scope of what we go into here because it's going to depend on the person's facts and circumstances as to whether it's appropriate and whether it would work at all, and then what the numbers would actually end up being. That's the basic idea.
Alrighty. So we have a general tax question, Neil. So what are some common tax filing mistakes people make and how can I avoid them?
Yeah. Okay. It's like I just go down the form itself. Oh, incidentally, this is not related to tax filing mistakes necessarily, but the in the tax professional world, when it comes to how things are entered on software, there's different software paradigms. Everybody's familiar with TurboTax. TurboTax uses what's called the interview method, where it asks you a bunch of questions, and then based on your answers, it fills out the tax return. Then there is the worksheet method, and that is on the tax professional side. There's a bunch of worksheets. You fill them out. It takes the information from those worksheets and it creates a tax return. I dislike both of those. So I prefer what is called the forms method, where you're actually looking at the tax return itself and you're looking at, okay, in box one, this type of information goes. And then you start to, from there, you dive into, there might be a worksheet or there might be a data entry field or whatever. But it gives, at least to me, and maybe it's because this is how I was trained up in the tax world, is that it makes sure that you don't miss anything because you're looking at the things like, okay, there's wages. Do we have wages? Yes. Okay, got to put in the wages. Okay, we have, next line is interest. Do we have interest? Yes, we got to put in the interest. And it makes sure that you don't miss critical things. When I go down the form in my mind, that's what I'm seeing. But okay, things that create problems. There's different kinds of problems when it comes to errors on your tax return. There's ones that guarantee that you'll have a problem, and there's ones that might cause a problem, right? And so the guarantees is when you have an information mismatch. Again, just going down the form. First thing is your name and social security number. Make sure that's actually right. Make sure. So, like my last name, McSpadden, right? My entire life, we spell it as me, my family, everybody spells it as one word. It's capital M, superscript C, but I just do it lowercase because superscript is a pain in the ass. Capital S, and then PADEN. On my social security card, when I was born, it's MC space SPADEN. So for official tax purposes, my last name is two words and not one word. So it's just weird things like that can cause issues. If you're a junior or a third or whatever, that can be an issue. So make sure that your name matches what's on your name and social security number matches what's on your social security card. That's number one. Same thing with your spouse, same thing with your kids. We had one client named Marcos, and so he was married. He had two kids, both boys, and he was named Marcos, and both the kids were named Marcos. And they didn't have a junior, second, third. It was just Marcos. So like internally they called them different things, like they had different nicknames, but that's just they were all just Marcos, whatever, and they all had different social security numbers. So it was so I remember when I first did their tax return the first year, I was like, is this right? But yeah, so make sure that your names and numbers match what the IRS has. Also, for myself, when I got married, my wife, she she was doing the name change thing, and the forms were confusing. And so on like her driver's license, her maiden name ended up as her middle name, but on her social security, it ended up as hyphenated. So it's this crazy long name because she had a long name and I had a long name. There's issues like that. Another issue when it comes to just the we're still at the top of the form. If you're married filing separate, you got to match. The two spouses have to both file married filing separate, and they both have to reference the other social security number, the other person's name and social security number. There's that. A slight exception to that if they live apart, there's a kid, whatever. But by and large, they got to match. So then, as we go down the form, there's your information, your address. Whatever address you put in, that's where they're going to send mail. Make sure that is correct and that you're able to access the mail from whatever that is listing. The kids or the dependents, make sure the names and socials are correct. Make sure that the birthdays are correct. We've seen an uptick over the last several years with dependents getting identity
Mhm.
theft protection numbers. We had one case where The client was not aware of an identity theft protection number, but the system rejected the return because it says, hey, we're expecting an identity theft protection number. So that was a whole issue because your identity is quite valuable and scammers out there will steal it. So that is other things to check. And then we get into the actual data. So make sure that you don't miss anything in that, like there have been cases, oh, my camera's about to fall over. Let's see if we can fix this. No, don't want to show you the green screen. So people sometimes forget they had jobs. That's not great because this is a third-party report, right? So the company will send you a W-2 and they'll send the IRS a W-2. And if you have a state income tax, they'll send the state a W-2 as well. If you leave that off, you'll get a letter, guaranteed, because it's a computer matching issue. And if you get a letter from the IRS that starts with the letter CP, that means computer processed. So that means it was automatically generated. There was no human involved. It's just there was an error or a mismatch in the computer, so you're getting this letter. Make sure that you include all your forms, all your 1099s, all your 1098s. You don't have to include, but you probably should because they're to your benefit. W-2s, all that kind of stuff. Make sure that they're all included and you're not missing anything. Because what happens, so we had a case of this about a month ago where a client got a letter from the IRS that says, hey, you owe whatever it was, $8,000. And we went back and forth and we figured out what happened was that the client had gotten some company stock that he had forgotten about and he had sales and it was taxable. The way the IRS looks at it is they've got a sale amount, they're going to assume that was 100% profit. Obviously, that was not the case. So when we actually went through the whole thing and we amended the return to include the correct information, it says, okay, yes, there was a sale of however much company stock there was, but he also had to buy the stock and the stock went down. So he actually had a net loss. So he actually was owed a refund. But it would have been better to not have to go through all that and just report it correctly on the front end. So make sure you include all sorts of income because that is a legal requirement. Other things, pet peeve of mine is 1099Ks. So
Oh,
1099Ks
yeah.
are the third-party processing reports. And if the IRS is to be believed, we're going to get 31 million new 1099Ks this year compared to previous years because there was a rule change. Again, Congress changed the rules. Under the old rules, if you had a payment processor, like American Express, for example, and you had at least 200 transactions a year, and the total dollar value of the transactions was exceeded $20,000, then you got a form. And again, just like a W-2, they give you a copy, they give the government a copy. The rule change is that there's no longer a number of transactions requirement at all, and the total processing volume threshold is now $600. So if you process more than $600 worth of payments, then you're going to get a form. Here's the problem with that is that people, they hear about this and says, I don't take American Express, I don't take credit cards, it doesn't apply to me. But what they forget is that there's lots of other payment processors too. There's PayPal, there's Venmo, there's Zelle, there's Airbnb and VRBO. Those all process payments on your behalf. And so there's a lot of people who are going to get these forms and not know what to do and end up probably paying too much tax. Because just because you got a 1099 does not mean that's all income. If you have your friends reimburse you for dinner on Venmo, that's not income. That's a reimbursement. We're still waiting on the form updates from the IRS as far as how we're going to have to report all this, but you got to be careful about what is actually going on. We'll see how that goes. But what a lot of people screw up on is when, let's say they start a new LLC, they're starting a side business with whatever, they sign up with Venmo or whatever. Like I pay my lawn guys in Venmo. My daughter's piano teacher, he takes Venmo. And when you sign up for these platforms, it'll have you go through a W-9 process. So that's the form that lists out a recipient's taxpayer identification information. And at the top of the form, it says name. And then it says, what kind of entity are you? And then it says, what's your social? So it's got two boxes. It's got social security number. It's got EIN, identification number. And you only fill out one of those. So what people do by mistake is they put in their own name and they put in their own social because that's what it looks like the form says. But the name, you got to remember, a company is a separate taxpayer. It's a separate legal entity. It has its own name. It has its own tax identification number. So they end up, maybe they started an LLC and they have a bank account and it's all, separated, but then they sign up for the payment platform under their social. And now they're getting a 1099 to their social instead of the company. And then we have to go through a process of correcting that. And it's just a nightmare. So if you get nothing else out of this, if you ever sign up for PayPal or Venmo or any of these, use your taxpayer identification number from your EIN, your employer identification number of your company. Just general tip, you shouldn't be doing business in your personal name. You should
Right.
always at least have an LLC. And I know technically that could be construed as legal advice. I'm not a lawyer. I'm definitely not your lawyer. But that's my experience as a tax guy. Have an LLC at the very least, and have its own EIN and have its own bank accounts and all that good stuff. So that's a major error that we see a lot. We had an issue with that on a client recently where he's got a bunch of companies, and then we were looking through his tax transcripts, and he has his 1099K under his social security number, $170,000. And we're like, what does this go to? And he didn't even know. And then we had to go back and forth. And then he figured out what company it should have gone to, and we had to do a correction. So don't do that. Other issues, the IRS. How much time do we have? We're at 6:45. All right, I'll just do one more.
Okay.
The IRS puts out press releases every year about tax scams. Make sure you are not a victim of one of them. If you ever under the current versions of the tax forms, 1040 page 1, 1040 page 2. The middle chunk in the second page is the credits. And these are refundable credits, meaning that even if you didn't pay in any money, the government will still pay you. So these are very valuable pieces of information. And a lot of scammers out there will just put in numbers and say, oh, I can get you $12,000 because you're putting in this number. And yeah, the tax return will say $12,000. But then when the IRS comes looking for that money, then you're stuck because you're going to have to end up paying it back plus penalties. I'll give you my favorite example of this. And if you ever see anything related to the federal fuel tax credit on your tax return, run for the hills. So in this particular case, this was back when I was working in Florida, and new clients come in, husband and wife, very nice couple, and we're working through their tax return. And they said, oh, and by the way, we got this letter from our thing last year. We never got our refund. I said, okay, let's look at the letter. And it was a letter saying basically that we're not going to give you your refund, and we're charging you a frivolous tax return penalty of $5,000, which I was like blown away by. And I looked up the code that it referenced, and sure enough, there is an internal revenue code associated with frivolous tax returns, and the language is basically saying that this return is so fake that even just looking at it, we already know you're just lying. So I said, okay, do you have your last year's tax return that we can look at? And I'm looking through it. And so the wife was a teacher or a nurse, one of the two, and the husband was an engineer. So I'm looking through it. They got a W-2 and they got a mortgage and normal stuff. I didn't see anything that indicated being a frivolous tax return. So I told them that. I said, there's nothing here that would warrant this letter. What you should do is you should go get your transcripts from the IRS. And this was before the web systems really worked, so you had to call and they had to mail them to you or fax them. It was the whole thing. So they come back a month later, and they show the transcripts. And sure enough, on the transcript, it shows a federal fuel tax credit of $4,000. And I say, okay, that's the issue. And what happened here? And we do some conversating back and forth. And what we figure out was that they went to the person they'd gone to the previous year, they prepared the return and they signed it, and it was just a normal tax return. After they went out the door, the guy added in the federal fuel tax credit to juice the return so that he could get a bunch of money. And he filed it, and the IRS noticed, and then they charged the couple with the frivolous tax return penalty because there's no explanation for a teacher and engineer to have a federal fuel tax credit. It just doesn't make any sense. Which I
Right.
agree with the IRS. That doesn't make any sense. But in this case, it legitimately was not their fault. And I went through this whole explanation with them. And I told them what they should do is they should go to the Taxpayer Advocate Service, which is an internal department in the IRS that helps taxpayers with issues where they can't get satisfaction, basically. And they should report that tax preparer to the Advocate Service. And hopefully the Advocate Service can help them get their money back. And then they tell me, oh, it was my husband's brother that did it. So we're not going to do that. And they just ate the $5,000 penalty.
Wow.
And I don't know how Thanksgiving went that year, but
Not good. I
it's
can
not
see
good.
it.
Not good.
Yeah.
There are pieces of information that you can put into a tax return that will still file, but will cause you massive grief on the back end. And you want to avoid all those. So basically, any kind of scam, anybody who says that I can get you this because of some nonsensical explanation, run away.
So, Neil, I have a funny question for you.
Yeah.
What did the tax auditor say to the taxpayer who wanted to play hide and seek?
What?
Good luck, but I always find you in the end. I thought that was so funny because we were talking about doing taxes incorrectly or wrong or fraudulently.
Yeah.
Stay away from that kind of stuff.
Stay away. Run away.
Yes.
Yeah,
Oh,
they're slow, but they will catch up to you. It takes them a few years in most cases, but yeah, they will come around to it.
all right. Neal, it brings me to the next question. Someone asked about hearing news about taking 80% write-off for a car, that they're letting you do that in 2024 versus 2023 was like 100%. Have you heard
Yeah,
about something like that?
so that's the bonus depreciation issue. So
Okay.
as we get closer to 2026, which is the expiration of the Tax Cut and Jobs Act, the bonus depreciation was 100% and is now going down by 20% a year. What that means in practice is that, let's say you bought, I don't know, a computer, maybe not a computer, something more expensive. You bought some machinery, whatever, it cost $10,000, and from 2017 through 2022, you could take that $100,000 and you get the full deduction in year one, even though that equipment might need to be depreciated over 5 or 7 years. So, and that was because of bonus depreciation. So the bonus was the fact that you could take the whole thing. And then starting last year, that 100% bonus depreciation started ratcheting down by 20% per year. So 2023 was 80%, 2024 is going to be 60%, and it's going to ratchet down further. Again, this was in the same law that was passed in the House and is sitting in the Senate and has been sitting there since January about fixing the R&D credit. They had a provision in there to change the bonus depreciation back to being 100%. But again, stuck. We're waiting. We'll see. But for now, this is one of those things that was in the last remaining years of the 10-year window that we are having to deal with. So yeah, cars and assets of all kinds are less write-offable in this year compared to last year, and it's because of this bonus depreciation issue. Now, cars also have special rules on top of that as far as limitations, because they don't want you to basically blow all your money on cars, essentially. But that's getting into the weeds a bit on the numbers. But the fundamental trend is correct that assets that you could depreciate more aggressively in recent history are now less in the early years.
Okay. Understood. So do we have time for another question, Neil?
Let's do one more. Yeah.
Okay.
Hopefully, I'll
So
be not so long-winded.
so if you had to think about taxes in the tax world, what are the three most important steps to make sure that you're doing your taxes correctly?
So,
Only three.
okay, only three. Step number one, and this is going to be general steps. Step number
Yeah.
one is you want to be planning ahead. After the year ends and you're stuck with whatever you got. So much of tax strategy is looking ahead. Say, okay, we're in July right now. The year is halfway over. First year, we made such and such. Back half of the year, we're expecting this or that with some uncertainty because the future is always uncertain. And so just knowing what that projection is, and then based on that, it says, okay, given that, what kinds of things can we do? And what kind of things do we have to do now versus later versus after the end of the year and so forth. So that's thing number one is get your planning done ahead of time. Thing number two is getting all your documents together. So if you have a small business, you got to make sure your books are done, all your third-party reports, the 1099s, the 1098s, the W-2s, you got to get all that together. And then step number three is making sure that you are filing accurately and taking advantage of all the strategy that you put into place in step number one. And if you do that, then you're good.
Okay. So
Oh,
5:55.
all right. We are just about out of time. I will share one last thing because people always ask what's next. Easiest thing to do is we do these every week. Go to taxsherpa.com/live. I've got to update the link right now, but it'll take you to the next week's live stream that we do. And then if you want some insight into how tax strategy works, go to taxsherpa.com/templates. And they'll give you our master tax planning worksheets for, again, this is for independent contractors, small business owners, that kind of thing. If you just have a W-2 and nothing else, it's ever since the Tax Cut and Jobs Act, there's much less we can do for you. So basically all of the, not all, but a lot of the tax planning opportunities are all the business side. So it's really applicable to business owners. And you, as a 1099 contractor, you are a business. And you want to make sure that you are set up in the right way to minimize your tax burden. So you can go to taxsherpa.com/templates. You can buy our template package there. It's all of $7, and that will walk you through the basic strategies. And these strategies are designed in such a way that they apply to all businesses, or almost all businesses. Definitely worth checking out. And you'll also get a checklist to avoid IRS red flags, which is some of the stuff I was going over with the mismatches and things like that. There's a bunch of others in that checklist. So yeah, that is the story. Again, taxsherpa.com/live for next week, and taxsherpa.com/templates to get our worksheets. Those are the same worksheets that we use internally and that have taken me like 5 years to build, and they're constantly being refined. So definitely worth checking out. Alrighty, that brings us to the end. Any parting words, Serena?
Come see us if you love your peace of mind. We give that back
Yes,
to you.
that is absolutely true. And I've got story after story of exactly that. Actually, that reminds me, Serena, on our so before we started the stream, Serena and I were talking. We were having an internal meeting, and I forgot to tell you, Serena. I won't use names, but so the one client where we were reviewing the numbers for the business he was looking at buying, we have to use his response as a testimonial. Where he's saying, "I was like, oh, this is way more in depth than things that I was expecting." Yeah, let's do that. All right,
Mhm.
that's it for this week, and we'll see you guys next time. All right.
Alrighty. Bye.